That one's got a red dot, so that one's going.
So this is like the editorial section. Like the in between the videos. The blooper take.
Sure. Hopefully, sound is recording.
Hopefully.
Since I unplugged and plugged it back in.
That one is, right?
Yeah, that one's going. That's my backup.
So this is where we talk about all of life's choices and how we improve the quality of everybody just by our infinite wisdom.
Yeah.
Pretty short. Infinite wisdom.
It's the same thing I tell my kids. Find that thing that brings you joy. Do that, and we'll figure out how to monetize it.
You monetize it.
Yeah.
Give me your let me give you your YouTube feed. Why? Because I need to pay for your college.
Yeah. It's not even, it's whatever. If you enjoy baseball, let's figure out how to get you good at baseball. Maybe you could get into the MLB.
Major League Baseball?
Yeah.
You are such a sports fan. I can tell. That's great. Suppose we should start.
Yeah.
Hi, I'm Tom.
And I'm Brian.
And we are the Dividend Dudes. In our last video, we talked about
this balance sheet, the exciting world of financials.
Stocks, yeah. Stocks. We talked about stocks. It's funny. You got a financial channel. You actually talk about finance.
That's kind of what we do. It's a stocks.
Yeah.
We talk about stocks.
Yeah, we do talk about stocks, don't we?
And dividends.
So we talked about the companies we looked at buying. I kind of got into a little bit of the detail about the methodology, about what we purchased and why we decided to pick the stocks we did. There are a number of companies out there that we could pick that are great performers that don't pay dividends. We didn't look at any of those.
No.
So on the list, hopefully there's an overlay somewhere, and if Brian is going to edit the video, I'm going to point it and he'll put the thing somewhere where my hand is.
Just going to move around is what it's going to do.
No, that'd be bad. So on this, we got a laptop in front of us. You can't see it, but we're looking at the same thing that you're probably seeing on your screen, hopefully. And we've got a list this time of 17 companies. We use the same metrics that we used last time to purchase, and on the list you're going to notice that they all pay a dividend. We're the Dividend Dudes. They buy stocks that pay dividends, so hopefully that's self-explanatory. So on this list there was again, we looked at Zim again because last time we did this, Zim was very interesting. I did not understand why they had such a high earnings per share. Like they really high earnings per share. So dug into it again, decided that still looks a little bit too risky for us. I couldn't stomach it. So
it's a weird stock because it looks okay on paper.
It does.
And then why are they at 35% yield for their dividend? It's just, we need a lot more analysis to figure out why.
Yep, and as these videos go on, you're going to see some of the stocks return, like the AT&T is in this list. We didn't buy AT&T because, as we talked about in the last video, you want to diversify, so I'm not going to put everything into one basket. So it's on there, but we didn't buy it, but we wanted to make sure we were keeping tabs on what we're doing so we know what happens with it.
Right.
So
would we still buy AT&T?
I think I would.
Yeah.
I think I would. They're still a pretty healthy company. What I would want to do if I was looking at the telecom industry as a whole is I'd want to compare AT&T to like Verizon and some of the other ones out there just to say, okay, how do they measure up? How do they stack up? Those companies tend to have a lot of operational costs because, they got to put wires on telephone poles or bury them underground. And I mean,
right.
There's a lot of equipment there. So if we were to do an annual or semi-annual or whatever the analysis would be, I would compare AT&T to other units in the industry or other businesses in the industry and see how they're doing, and then I would make a decision. Comparatively to these other stocks, because the one that we purchased is in a different industry segment, I really wouldn't compare AT&T to the one that we purchased. They're different businesses, so I mean they have different things that they do. So
that was the idea, is to diversify and not pick another telecom stock or
right
somewhere in that segment or that industry.
Right, and we talked about that with crypto too, is why you don't want to just buy nothing but crypto. We actually know somebody who told me that they diversify. Great. You diversify.
Buying Bitcoin and Ethereum and Cardano and Dogecoin, that's not diversified. You're still buying the same thing.
Yes.
It doesn't matter which one you buy. I mean, one might go up and one might not go up as much, but they're all tied together. So, yeah, it's
So-
not diversifying.
Yeah, that's a good point, Brian.
That is a very good point. Thank you.
So when we're talking about diversification, this particular portfolio is not far enough along where we can really truly take some of the stocks that we already own. We own 2 of them now, and actually look at where we would buy elsewhere. I mean, at least not yet. The only exception to that list is if AT&T decides to, I don't know, do something that would destroy their business and all of a sudden they lose all their money, which would not be good because there's a lot of people that use AT&T for phones or internet or other stuff. So if that,
TV.
if that happened, then we might look at selling them outside of that. But for the most part, we bought them for their wonderful 25 cents a month dividend checks.
Right. And we could have this month put that $400 back into AT&T and double that, which wouldn't be a bad choice at this point because, I mean, it's just 2 shares or whatever it is.
Not very many shares.
So yeah, so we could absolutely have done that, and there's no real need to diversify at this point, but just for the sake of keeping to our philosophy,
Yep.
we're diversifying.
And we're trying to do that again based on the $400 a month that people have left over, based on what the U.S. Census said is the average household income.
Right.
So this portfolio is supposed to be based on what people have left, the average person has left. So we're going to be building it based on that, so that you, as a person watching this, will see that long term. Hey, it really does work. It worked for us. So showing you what we have now doesn't help you because it's not going to meet you where you're at.
No, it's
So
just showing you how to start, how to make that first step off the couch.
Yeah, I think it's a whole lot different telling somebody that, yeah, we did it, it's great, and then they don't have any way to know how.
Yeah, how'd you do it?
Because I could show it to them. So, well, that's great. You make lots of money in dividend checks. Well, yeah, but I started with,
$400 a month.
the 25-cent dividend check that we're talking about right now.
Are we ever going to get a raise?
You do get raises. Most companies that are healthy and can afford to increase their dividends, they do. Not just naturally through inflation, but because the company grows. Maybe they increase the price of their product or whatever. And if you look historically at some companies, not all of them, they will actually increase or have a likelihood to increase the dividends. So maybe, I think the average is 9 and 12% per year or something like that. It's that they grow. So if you're making 25 cents per month now, you might be making 28, maybe 30 cents, per month in a year or two. It depends on the company. Not every company can do that, and that's also why when you're looking at this list, these companies that pay, some of them pay just huge dividend yields. The one that BlackRock Innovation and Growth Trust, you look at that, man, it's like 14.7%. That's a lot. You give them $1,000, they pay you a lot. That's $140 basically through the year.
Right.
That's pretty good. Yeah, but then you look at, can they afford to do that?
For long term.
Yeah, they can't.
Or grow that. Will it be 15% in 2 years or 16%?
And it's important to recognize that too, because when you buy a company for the dividend, they have to be able to afford to pay you that dividend. And most companies are capped at their dividend about how much they earn. So if they're going to pay you, in that case, 14.7% or 0.76%, they have to come up with that money somewhere. So they could do it by laying off a bunch of people or I don't know, selling a crazy amount of product. Or they could buy assets and sell them, or they could just have a whole bunch of buildings that they sell. The problem is, when a company does that, let's say you have 100,000 employees and you want to pay a big dividend check. Well, okay, we can't afford it. So they lay off a bunch of people. Great, you just got an injection of cash. You'll see it on the cash flow statement. It'll look good. Their income will look really good because it went way up. But that doesn't last. All of a sudden you've got 25,000 people that are out of work. That's not good. And then you've got 25,000 less people who are producing product.
Correct.
Those people are not helping the business grow. Now, maybe they were a bunch of leeches who never did anything, but for the most part, if you're a very productive and hardworking office individual like me, you'll at least get an hour or two per day of good productivity.
Right. But you also find that most companies don't okay, we're going to find the lazy people who are a dredge on the company and get rid of them. They don't. They look at the bottom line of salaries and say, oh, you make a lot of money. Is there any other people that do what you do? Yep. Okay, we'll get rid of you, and then we'll put your work on the other people that are still there.
And that conversation, I was like, what have you done for us lately? It's like, what?
Yeah.
What? What do you mean? I worked 2 hours out of an 8-hour day.
Yeah.
Not everybody does it. I'm not insulting office workers because I am one. You know, the typical person who's on salary works more than an 8-hour hourly person because they figure, well, hey, you know, show up at 7 and work until 7, you get paid the same amount. I actually made that discovery the hard way. Thought, hey, I'm going from hourly to salary. This is years ago. I thought I was getting a pay raise.
Right.
And looked at my check and the amount of hours I worked. I worked from 40 hours a week on hourly, and I went to about 60 hours a week on salary, and it was like, oh, this is not a pay raise.
I was making more money getting the overtime.
Yeah, so, I mean, that's kind of the point behind the dividends, and the companies that we select, they have to be able to afford the dividend.
Right.
And if they can't afford to increase it, they have to at least be able to pay it out without sacrificing the growth of the business.
Exactly.
So there's limits. And just like when you're salaried, there's limits. I can only work so many hours in a week. So as a business, if you have 100,000 people, you fire 25,000 people. There's only 75,000 people left to do the work. It's a lot of people, but
yeah.
I mean, for the sake of the discussion of the video, 75,000 people cannot, or if it was only 75 people, if 75 people cannot do what 100 people do. They just can't do it.
Right.
So you might get a big check from this Zim International or Zim Integrated, the shipping company, or BlackRock Innovation for a little while, but then it tends to drop pretty quickly after that. AT&T is actually a perfect example. If you look at the historical dividend, they were paying close to 9% for a long time. Couldn't afford it. Their stock just did this for a really long time. Now they divested from Warner Brothers, that became a separate symbol, WBD, and their stock went down to 5%. And all of a sudden, the stock starts going up, and their earnings per share looked better, their price to earnings ratio looked better, everything looked better just because they decided that, well, I guess we can't afford this. So you have to keep that in mind. A big dividend does not always mean that it's a good thing.
Right.
Because sometimes when a company, you know, that pays a really high dividend starts getting into negative earnings, it not only affects the fact that they can pay the dividend, it affects the stock price. The stock price goes down too. So you don't want that, especially if you're looking at selling the company because they're not making money. If you sell the company, at least get what you paid for it. So when we buy these companies, and again, on this list, there was a couple in there that looked really good. It was a very hard decision. You probably would not go wrong with about 4 or 5 on this list. But again, we had to look at some very close things on income statements, had to look at cash flow statements, had to look at balance statements, and we also had to take into account the dividend, the very thing we're talking about, just to make sure that, you know, can they pay it? Does it look like they're going to increase this dividend? And, you know, is this a company that we understand? And there's a couple we didn't, and for the most part, this one we did. So on the list, if you look at the way it's sorted, our earnings per share is all the way at the top. The bottom one, you see the negative earnings per share on BlackRock. That means they're not making money. You got price to earnings ratio sorted as the second one, and then the dividend yield is the third thing on the chart there. We covered those mostly in the previous videos. We did not cover, except for the last video, how the balance statement, the cash flow, and the income statements actually reflected our choice. So we'll probably get into that in the next set of videos, maybe just one of those things, because I know we can be boring, but I don't want to be too super boring. So the stock we picked was Merck & Co. It's a pharmaceutical company, so it's kind of opposite of what AT&T does. That one was a very hard pick between them and Pfizer. Pfizer looked good, Merck looked good.
General Dynamics looked good.
Yep, General Dynamics looked pretty good. There's a few other ones in there, and if you'll notice, there's like Ford and Honda Motor Corporation. I personally own shares in Honda, so I put them on there, and I just bought more, and I just, for the sake of dividend dudes, I couldn't justify buying more Honda for dividend dudes, just because Merck looked better. Does that mean I'm going to sell my Honda Motor Corporation stock personally and buy Merck? No.
No, it's still a good choice.
Yeah.
It's just not the best choice.
Yeah.
For us.
And they looked good. I mean, a lot of the companies, by the time you get over about 3 earnings per share, as long as they're not lying about that. They're being honest about it. That's a pretty healthy company. So in this case, we bought Merck & Co. We got $400 worth into that. So we're
A little bit less, but...
A little bit less. The platform Ameritrade, if the guys from Ameritrade are watching, we would like to know how to buy fractional shares because we can't do that for some reason. So
I'll look into it.
Yeah. So on that note, we have another $400 worth. Our portfolio totals about $807 because AT&T has gone up. We're not looking at that. Total invested is $800. We get 25 cents a month in dividend checks from AT&T. We're adding 25 cents from Merck & Co.
Yeah,
we are 50 cents per week. It's not much, but
it's something. It's a start.
it's a start. Yep. And again, these companies pay quarterly, so what you're going to see is it's not going to be 50 cents every week. It's going to be once every quarter that they pay you, so you'll get a couple bucks every quarter. What we're going to do for the sake of the video is we're going to reinvest those, so they'll just go into the next company that we pick. Some people may choose to do what's called drip funding. They might just reinvest their dividends back into the same stock. That's okay, but I would caution you on the fact that you need to pay attention to their income. If they're doing okay financially, that's not a bad deal. But if they're not doing okay, well, you just invested your dividend check into somebody who's probably not going to spend it very well.
Right. Yeah, I'd rather take that, add it to the $400 that I've got for that, and add it, $405 now, and then put that into a better stock.
Yep, and it depends too on what kind of portfolio you have. If some of that can be tax-free, some of it may not be. So if you take the dividend and you put it in your personal bank account, you're going to get taxed on that. But if you keep it into certain assets that are not taxable, you won't pay taxes on it as you reinvest it. So that's okay, because it's an unrealized gain at that point. You're not actually collecting on that money.
Right.
Sometimes, as this portfolio builds up, if you get a nice, let's say it's not 50 cents, let's say it's $500. Let's say you get a big check, $500. It's not bad to reward yourself every once in a while. Just keep in mind that at the end of the year, you will have to account for that. So you will have to go into your tax, person at the end of the year, you're going to get a form for that. You're going to have to fill out if it's a K-9 or 1099 or whatever form you get. You're going to have to tell them this is what you made, and then you'll pay taxes on it. So if it's $50,000 and you weren't planning on that,
right.
You need to make sure you take some of the dividends and you put that aside to pay taxes at the end of the year.
500 isn't going to affect much, but 50,000 will.
Yes, 50,000 will.
Unless you're making, $1 million a year, 50,000 is quite a big deal.
Yep, and for our portfolio here, $800. I mean, that's not that much.
Right.
Apparently, that buys like 3 gallons of gas today. Because that's the super reasonable price of gas. It's not like I feel like they're manipulating the supply chain and all, but
No. They wouldn't do that.
So again, thank you for watching the videos. If you've got anything you'd like to comment on or you'd like to see us talk about, please comment on that in the videos or shoot us a direct message and we will try to get to it. These videos are still delayed, so we tried to train ourselves in how to make the videos. Then we released them in a staggered fashion just so that we knew what the heck we were doing by the time we actually fully went public. So if you start commenting and you want us to do stuff, please note that this video is probably the first start of us getting caught up to be real time. Eventually we plan on doing some live streams so you can ask questions real time and make fun of us real time, like why does Tom keep touching his glasses and why does Brian keep changing and or not have glasses at any one point in time, or why doesn't Tom shut up, he keeps talking. Those things can all look at me like that.
I'm just waiting for you to stop talking.
Yeah.
Well, now you're gonna stop talking.
Yeah, now I have to stop talking. Is that long enough?
Yep.
Okay, that's long enough. That's like 1 second.
Awkward silence.
It's hard for me to do that.
We should do an awkward silence.
Awkward silence time. Oh, we're actually doing it. Oh.
One of us is doing it.
See? I will be happy to help you with your comments by explaining whatever it is that, I think I know the answer to.
Yep.
Brian will help you.
Any questions, comments, concerns? Okay, just questions.
No trolls.
No trolls.
Yeah, I'll go into a state of deep despair and depression.
We won't delete the troll, because trolls are funny sometimes.
Yeah, they can be. You could say something like, hey, you guys look cool, and it'll just tell you to jump off a bridge. It's like, well, what? So anyways, thanks for watching. Until next time, happy investing.
investing.